you have to think about what the purpose of amortization is. So when you're originating fixed rate loans, typically those loans are being made on properties that are stabilized. So these are properties that have more or less reached their value, their value max. You may see over time, obviously, some increases in rent that'll boost the value a little bit. You may see some changes in occupancy that may boost the value a little bit. But these properties that are the perfect candidates for fixed rate loans are not going to be the more transitional, heavy lift assets where your business plan is to take them to a completely different value, to get a very accretive bump in value. And so when you're originating a loan, one of the things that you want to do as the originator is find ways to de-risk your credit. And amortization is a way to deleverage over the course of the loan, so that when you get to the maturity, your balloon balance is smaller than your original loan was. And that's helpful to you when you're refinancing, particularly if you're refinancing into a more difficult market than when you originally originated the loan. One is how much deleveraging you're hoping to accomplish. So if you're going in at a higher leverage point, a higher loan to value, you may want to consider a tighter or shorter amortization schedule, because this way you'll achieve more principal pay down during the term of the loan and more deleveraging. If you're going in at a lower leverage point when you originate the loan, that's when you can maybe extend the amortization term out longer, because you're not looking to amortize or deleverage quite as much. The other thing that would determine how you would choose a specific AM schedule would be the property type. So if you think about all the different commercial real estate property types as sitting along a risk spectrum, one end of the spectrum are the more stable property types like multifamily, self-storage, industrial. And then at the other end of the spectrum are the most risky asset types like hotel, healthcare, things that have an operating business component to them. The more risky are the ones where you would want to see more deleveraging if possible. And therefore you would want to try and use a tighter amortization schedule for something like a hotel than maybe you would use for something like a multifamily property.